Elena and David have successfully conquered the mountain. They possess a fully funded 6-month emergency fund safely sitting in a bank account. They are mathematically resilient to life's sudden shocks. But ironically, crossing this finish line introduces a completely new, more sophisticated financial dilemma. While cash protects you from sudden emergencies, it exposes you to a slow, silent, and relentless thief: inflation. Every day that a massive pile of cash sits idle in a traditional checking account, it loses its purchasing power. It is slowly evaporating. In advanced personal finance, hoarding excessive amounts of cash introduces a phenomenon known as cash drag. Cash drag is the opportunity cost of holding liquidity. It is the substantial amount of compound growth you forfeit by not deploying that capital into appreciating assets like stocks or real estate. If David and Elena decided to save 3 years' worth of living expenses in cash just to feel perfectly safe, they would be sacrificing hundreds of thousands of dollars in long-term equity returns. They would be losing money safely. However, the pendulum swings both ways. If cash drag is the danger of being too conservative, sequence of returns risk is the fatal consequence of being too aggressive. Imagine if David invested 95% of his net worth into the stock market, keeping almost zero cash. If a recession hits, the stock market crashes by 30% on the exact same day he loses his job. Without cash, he is forced to liquidate his stock portfolio at the absolute bottom of the market just to buy groceries. He permanently destroys his capital because he lacked a buffer. So, what is the optimal equilibrium? How much cash is too much and how much is too little? The answer is dictated by your personal risk tolerance. In the financial world, we often use a highly subjective but deeply important metric, the SWAN metric, which stands for sleep well at night. A mathematically perfect portfolio is utterly useless if it causes you chronic insomnia. Your cash buffer must be large enough to silence your anxiety, but small enough that you are still aggressively funding your future. Elena and David calculate their specific risk profile. Because they are a dual-income household working in relatively stable corporate industries, the risk of both losing their jobs simultaneously is statistically low. Therefore, a strict 6-month buffer is highly adequate for their SWAN metric. Conversely, if David were a freelance entrepreneur with a single, highly volatile income stream, a 6-month fund would be insufficient. A freelancer or business owner might require 9 to 12 months of liquid capital to absorb the severe fluctuations of inconsistent cash flow. We must also apply a global macroeconomic perspective. The concept of holding cash varies wildly depending on your geographical location. In developed economies with stable currencies, holding a 6-month cash buffer is standard, safe practice. However, if you reside in an emerging market, experiencing hyperinflation or severe currency devaluation, holding static cash is extremely dangerous. In those volatile environments, individuals must convert their emergency funds into more stable foreign currencies or highly liquid, inflation-protected assets to survive. To optimize their 6-month fund, David and Elena deploy a sophisticated tiered strategy. They do not leave all $15,000 in a single checking account. They structure it for maximum yield while retaining liquidity. Tier 1. 1 month of expenses remains in an immediately accessible checking account for instant emergencies. Tier 2. The remaining 5 months are transferred into a high-yield savings account, HYSA, which earns a respectable interest rate, partially offsetting the damage of inflation while remaining accessible within 48 hours. With their defensive perimeter officially established and optimized, a momentous psychological shift occurs. The $500 a month they were aggressively funneling into savings is now completely liberated. It is time for the pivot. It is time to transition from playing defense to playing offense. They restart their investment engines. They direct their capital into diversified index funds and retirement accounts. But this time, the emotional context of their investing is entirely different. They are no longer investing with a sense of underlying panic. They are investing from a fortress of absolute stability. Because their emergency fund exists, David and Elena possess a superpower most retail investors lack: emotional detachment. When the stock market inevitably experiences a massive correction and headlines scream about financial doom, they do not panic sell. They know they have 6 months of liquid cash to survive any personal shock. They can afford to let their investments ride out the volatility, allowing compound interest to do its slow, miraculous work. Their safety net protects their psychology, and their psychology protects their portfolio. Balancing an emergency fund and an investment portfolio is the art of mastering both fear and greed. Too much cash and you lose to inflation. Too little cash and you lose to volatility. Finding your exact swan metric is how you build a financial architecture that can withstand both the economy and your own emotions. We have spent this week discussing the mathematics, the mechanics, and the strategies of risk management. But tomorrow, we are going to explore the profound, intangible benefits of this journey. We will discuss emotional security, why peace of mind is the ultimate form of wealth, and how financial resilience directly protects the soul of your family. Make sure you tune in.